Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
That's the problem with the casino. When you get into the casino, everybody gets caught up and there is no patience. It's like, hey, let's let it roll. And then the large majority gets wiped out after they've built up this massive amount because they're not sweeping anything off and they don't have an exit strategy.
Hello, everyone, and welcome to this episode of Finance U. I'm your host, Chris Martinson. I have at least 30 years watching markets, watching them very, very carefully. I have my subspecialties. I really like oil, gold, commodities. I've been really looking at them, but I've just been in in observer mode, looking at markets. So, back with me today, of course, is Paul Kiker of Kiker Wealth Management, also with a few decades of experience and a little gray hair to boot, possibly related to those experiences. But we're here to decode the markets, try and figure out what's going on, have a good conversation so we can figure out what is even happening these days. Good to see you again, Paul.
Good to see you again as well, Chris. Great intro.
All right. Well, let's start here today, Paul. We have to talk about markets. Markets. So I just guess this is sort of a grab bag. I just got a few things I want to talk about here today. Whatever you want to talk about is fine. This came across just last week sometime. And Bank of America warns that bullish sentiment has gone too far, they say, too far. They say investor optimism has reached its most extreme level since 2021, signaling it may be time to cut risk. Its bull-bear indicator jumped to 9.7, driven by strong stock market credit inflows, tighter spread. So here we are in this little red circle. This is higher than at any other time this year. Obviously, we had some bearish moments back here, but this puts us in good company. That moment right in 2020, you remember when you were talking about, like, we had that crazy moment, like somebody was goosing the markets hard coming into COVID, right? We had those last final few advances before they finally crumbled there. Otherwise, we got to go back to February of 18, March 2010, January of 04. So we've been here a few times, but this is very, very bullish. And, well, we all know what happens after everybody's all on one side of the boat. Often the boat tips over.
I would say there's times where the markets shift from markets to casino. That's just an indication of the casino mentality right now. It really is. Now, you go back to March of 2010 where you highlighted, I get that, right? After you come out of this massive major market decline, sentiment shifts, you get this initial burst of rebalancing for the growth. Of course, they were printing money back then. And then that euphoria works off, but that's driven from kind of the institutional side. Retail jumps on. Coming into 2020, I was blown away. That was actually the first time that we ever front ran our indicators. And what I mean by front running is, you're warning about what was happening under the surface, the potential for lockdowns, and the market kept running. And my concern was, hey, if we wait to cross some of our exit lines, the market, if we get a shutdown, it's going to happen too quick. One of the scariest decisions that I ever made, but it was the right decision in hindsight. Now, most of the time you've got to let this market, kind of roll over, but that's just a measurable indication of a rhythm that we go through where investors are just so euphoric, they're speculating. It's understandable because the narrative's like, hey, Trump's not going to let anything happen to the markets. They're going to print money. They're going to bail us out. But we didn't have the inflationary pressures before. You also didn't have a situation, you go back to 2008, there was a collapse of credit within that money supply, and money's being printed to fill that hole. But in the backdrop right now, you've got the, destruction of supply of the blood flow that we need for the global economy, and that can't be fixed with printing money. So I'm very concerned about the level of risk taking and all of the measures, the valuations across the board. I mean, we're continuing to break record after record from valuations historically. And those are warnings of the past. Does it unfold exactly the way it did in the past? No, markets aren't that easy. They're not. But this is the period of time when you look at indicators like that. If I could say one thing to investors, it's like, look, even if you're concerned about inflation, okay, to peel some money off the top of that portfolio and ladder out the next, especially if you're retired or you're close to retiring, peel some off, take some profits, get 2 or 3 years worth of income built into your portfolio that's safe. And yes, it might lose to inflation. But what happens if you have a major market decline and you're so concerned about inflation that you have no reserve or profit set aside and you're forced to sell something at the worst time? Because every time is different because it doesn't unfold the same way, but this time is not different historically. The market is going to deliver massive amounts of lessons and pain to investors that become complacent. They build themselves into a narrative. And even if we don't get a massive deflationary outcome and we get inflation, there's still going to be volatility that if you're not prepared for it and have resilience in the distribution phase of your investing life cycle, that could force you to be liquidated of some positions at the absolute worst time. Mm-hmm. So, you want to be contrarian from this standpoint, build resiliency in your income over the next couple of years. And hey, if you lose a little bit to inflation on that part, it's kind of like fire insurance on your home, right? Are you going to quit paying fire insurance on your home just because the house hasn't burned down the past 10 years? The consequences of that house burning down financially without that insurance overlay, it can be catastrophic for most people. So, that's why it's important to have a plan in place. But I do believe that now is a time, especially in those sectors that the euphoria is so strong, to begin just sweeping some profits out, right? Take that, especially if you're in the distribution phase, to build some income resiliency. Because the best situation you could be in if you want to be passive, and it's not different this time, and the market did have some deflation and it dropped 20, 30, 40, 50%, which is completely within the realm of possibility based on every scenario that we've been in historically up to here, then you're going to appreciate the fact that you've got some income that was locked in that you can use to live on for 2 or 3 years and buy some time for those assets to recover. Now, personally, we deal with it with a risk managed portfolio, but I do believe that, we would lower risk in the portfolio as we start to cross those thresholds, but we still build some extra resiliency in there as well, because there's no guarantee that you're going to be able that you'll be able to limit those losses, right? If the market was, some event happened on a Sunday and the market crashed 30% on Monday, it wasn't an economic event. It was a major earthquake or a terrorist attack or something. You still have to have that built in, even in a risk managed portfolio. And look, that Bull Bear indicator, and Michael Hartnett, which has talked about that, has been spot on with telling people and when it gets really low, time to ramp up your risk a little bit. When it gets really high, it's time to dial that risk back a little bit. What
do we notice? Cycles. Things go up, things go down. Things go up, things go down. But in those red circles at the top, that's where people get locked into this idea. No, they only go up, and they only go up forever. And, I'm sympathetic to this idea that potentially the powers that be have gotten themselves really locked into an asset bubble that they're desperately afraid. They don't know how to let the steam out of it. So they just keep putting more liquidity into it because they don't know what else to do. And that's crazy to me because a lot of it, as we talked about last time, 50% of the profits that came out of this very strong earnings season were due to so-called AI companies and hyperscalers counting the increase in their investments in each other, because they took equity deals sometimes, counting those as profits. Half the profits were those deals. But when you really peel it back, Paul, it's really confusing because they have a lot of really very sophisticated financial things, SPACs and vehicles and insurance and this and that. There's all these little pools of money. And when you start untangling, you find out that A invested in B and B loaned money to C, so C could buy products from A, and it just goes in a little circle like that. And I peel back a lot of those, Paul, and I come up with the idea that was a zero-sum activity. But all three companies will be reporting gains on the back of it, Well, but it helps asset prices. It is zero-sum in the end, but each
each step in that process, somebody's able to use leverage to borrow more money to expand that in the interim period, which makes the other side of it even more devastating. And look, here's the argument that I get. It's like, look, we're in the middle of the argument I don't understand that the market seems to be projecting is like, this is going to last for 30 or 40 or 50 years. So let's assume that there's a point where they get to this super artificial intelligence, the one ring to rule them all. Well, if it's that good, that's going to build the robots to make the semiconductors for itself, and then it's going to reach a point where we're not going to need all these semiconductors for that build out. So this is cyclical, just like it was cyclical back in the year 2000. Does it last a little bit longer? I don't know. So, but it seems to be that the market has convinced itself that this is going to be the answer forever, right? Similar to the railroad bubble that's back here. I mean, the railroad infrastructure was unbelievable in the impact that it had on our society, but we still got railroads today and we don't use them as much as we probably should. But once that infrastructure is built out, that monies and profits and expenditure is going to be going into a different area. The question is when is it completely built out? And with all this leverage underneath the surface, it just makes it even more risky to the downside. And technology is always going to be an aggressive investment because the moment that somebody develops a new chip that's cheaper and faster and smaller, if NVIDIA can't buy that company out, right, and they get their funding on the side, then all of a sudden that money's completely redirected, and what happens to all that debt and leverage that's built up in the system? So that's a risk within technology because it moves so fast anyway.
Yeah, oldest story in the book, right? That's right. Just the story of technology. You mentioned before that the markets had to say maybe a little bit of a casino flavor to them.
Yes,
I found your casino headline today. Wake up today and find out that last night CoreWeave, which is an AI cloud provider, caught up in the whole AI thing. CoreWeave stock soars after earnings and an important inflection point. And they say here that the stock rocketed up as much as 20% higher in pre-market action after reporting revenue doubled over the past year. You read down 4 or 5 paragraphs because I'm that kind of guy. I do. And down there you find out that for the second quarter, CoreWeave saw losses per share of minus $1.14 per share on revenue of $2.5 billion, whereas Wall Street was expecting losses of $1.41 a share on revenue of $2.5 billion. Paul, when companies are reporting dollar plus losses per share and they rocket up 20%, you got quite the story going.
That's quite the story, and people get ridiculously excited, and it's amazing how fast it moves like that. It really is. Speaking of that, CoreWeave's up 18.7% right now on the 12th. 18.7.
Yeah. Well, it's because they only lost $1.14 a share.
Yeah.
We were all expecting much worse. But there's a lot of that going on. I mean, and the one thing, there's a guy out there, Jay Martin, if people haven't seen it, but he compares what's happening in the AI space on a bubble standpoint, like how the financing self-feeding until it will turn on itself. And he compared that very, very cleverly to how housing actually broke in 2006 and 7, right? And it wasn't that houses fell in price. It was just that they stopped going up in value as much. And you needed like a 15% year over year appreciation in order to justify rolling the loans back over so you could just remortgage these things, refi them, and just keep refining them, just taking up more and more of that equity as it was. Turned out to be fake, but and that was cool because then you could pay the underwriters and, the banks could take a cut and, blah, blah, blah. But as soon as that just slowed down, as soon as houses went up, say, 6%, the whole model broke because it was a model predicated on, harvesting the underlying value in the assets. Similar kind of a thing going on with, making investments in companies that are valued at 1 billion, 2 billion, 80 billion. Do we say 80? We meant 100 billion. We meant 200 billion. We meant 500 billion. We meant this is the first non-public company that's worth $1 trillion, And so that allows them to secure more and more funding in terms of both debt and equity, right? And that keeps the whole thing going. So it's kind of an interesting. I'm going to have him on my show a couple weeks out. I think we're going to talk about that because it's a very compelling theory. I like theories.
I'm looking forward to that. I'm going to have to search him out and followed that because that's an important theory to pay attention to. And Chris, let's go, talking about that indicator, just how euphoric the market is and kind of the casino. Mm-hmm. I mean, look, from a long-term standpoint, the amount of euphoria and marketing that was around the SpaceX public offering, IPO, and you look at it today, for those that were patient, it was what, 225, 226, somewhere around there, just as soon as it came out. And then after the price drops all the way back down to around $105, is the point where those that were patient had the opportunity to buy that stock from a long-term standpoint. Now, I'm not saying it's good there. I'm just saying there are times when there's so much euphoria, you're better just to stand back and wait, because the large majority of the time, at least in my 28 years of experience, patience is rewarded from a long-term standpoint. Fear is not rewarded. Fear that paralyzes you where you don't make a decision, that's not going to be rewarded. That's going to be punished. But patience, to where you follow a strategy and, hey, the large majority of the time you get a better entry point. So, that's the problem with the casino. When you get into the casino, everybody gets caught up and there is no patience. It's like, hey, let's let it roll. And then the large majority gets wiped out after they built up this massive amount because they're not sweeping anything off and they don't have an exit strategy.
Well, I mean, things come, things go. It's easy to get swept up when things are headed a certain way. So we saw that with metals, silver and gold at the beginning of this year, both rocketing higher, but they're both busting some moves here this past week or two. So I thought maybe we could talk about that for a second, because I put this in the Fat Pipe North Star, pointing out from a technical standpoint, silver possibly one of the most amazing setups in my investing lifetime. Paul, what's he looking at?
He's looking at a long-term major cup and handle formation, and it looks like it broke out and has retested the resistance line, which is potentially the launch point. Mm-hmm. And yeah, so he's got target 1 and target 2. I can't see the numbers over there, but that's a major long-term pattern if that continues to execute, and it looks like it's following the pattern. It really does.
Long-term cup and handle. So for those playing along at home, this is the cup, this is the handle, this is the neckline of this cup and handle. It broke out, went up to 110, fell back here, and this little tiny little thing, silver's kind of going the other way now. Last I checked, it was like 67, I think. Something like that. When
we talk about the metals, one of the things that I really like about what I've seen in the price action here recently, spot looks like it's around 65.50 paper silver prices. But you had this euphoria. We had this major correction, which was actually worse than what I anticipated it to be. And then we've been basing around some pretty important levels. And then we've broken out of these trend lines with gold, with silver, with gold miners. And there's trepidation. Hey, is this just a retracement of that pullback? Are we off to a long-term bull market? Hopefully it's going to be one that builds slowly. I don't really want to, I know everybody that owns it wants to see it go straight back to those highs, but I want to see a sustainable continued trend higher. And, the price action looks really, really attractive, and I like the fundamentals from a long-term standpoint. Not a recommendation, just a discussion of what I'm seeing here. And I even like commodities in general. The fundamentals continue to build.
I do like energy here, no question about it, but not bonds. I'm not a fan of bonds right now.
No. No.
Man, they just keep selling off.
Yeah, long-term bonds are pretty interesting. And, I think I had mentioned before, just to talk about the fact that we had exited, I can't remember exactly when it was, but, 20-year treasuries after kind of the COVID run. I can't remember exactly when it was. And then it sold off pretty heavily and started building a base about the price range that it's in right now. And we basically gone nowhere for 2 or 3 years, but I like the setup for a trade, not a long-term investment. But we're flirting with major support here, and we're testing that line. We haven't broken through it from a long-term standpoint, but if we break through to the downside, that's a major negative for long-term bonds. And at this point, my thesis has changed. My upside risk, upside potential has been reducing and reducing and reducing just because of what we're seeing take place in the bond space. It seems like the bond traders, whether it's AI or other areas, those bond investors are the smartest in the room, are demanding higher and higher interest rates for the level of debt that's out there. So that tells me they're starting to see some risks under the surface that, hey, maybe these aren't as high quality credit risk, that the risk is greater than what the market's been anticipating, and that's what we're seeing. And my concern is that's going to ripple across the board. And if you see these, TLT break down out of that range, that means yields are going to go up. And if you see the 10-year continue to break out, then that's a major game changer for the markets in general and the economy and the financing of that leverage that's out there. And look, in addition, Chris, I'm learning as much about the potential ramifications of the unwind of that yen carry trade. I'm really concerned that that's going to be like a major asteroid that hits the ocean within the, an analogy from an economic standpoint, because the more I'm digging into that and the more I learn, it's always been in the background. I knew that it was a risk. I knew that it was there. But the more I research about just how much liquidity that's provided to the global economy, if that is over and it looks like it's ending in its days, that's going to have massive ramifications for the global economy.
It will. It's really hard to get our hands around because nobody really knows how big it is. It's big, or it could be ginormous. We don't really know.
So complicated.
Yeah,
you're right. Yeah.
But it's been part of this larger sweep, which is what's called the financialization of our lives, right? So everything's a financial transaction right now. GM really doesn't make money on cars. They make money on their GMAC side, loaning money for the car. So they're really a financing company with a car company bolted on the side. This is true across so many industries right now. So, and all of these financialization defined as making money with money. That's it. That nothing else need apply. Like no other good or service, no societal benefit, nothing's happened. But you made money with money, right? And all those profits that come from making money with money, well, those spend like real money. So that's what we've been seeing. And of course, with more financialization, you get like this larger and larger gap between the wealthy and everybody else. And, and that leads to like the younger generations really being left behind, because by definition, it's pretty hard to really get ahead in the financialization game unless you already have assets to start with,
That's right.
I mean, it can be done. We love our rags to riches stories, but it's pretty hard. If you go Wall Street bets and you look at the average trading account, they always have this mysterious little spike at the beginning, and then they just bleed away over the next year or two to zero, like over and over and over again, right? And those are the people who are trying to play the game, but the game is heavily rigged against the small player. And I always wonder about that little spike, Paul. Like I see it a lot. That's how. And I don't wonder if there isn't some algorithm out there that says, "Oh, we got a new guy. First thing we do is we hook him." Right? We give him some successes, and then we take everything he's got.
Yeah.
Methodically.
Yeah.
I don't know.
And I see it a lot with people that they'll get onto something intraday trading. They get a reward, and they'll ask me, they're like, "Hey, you've been in the industry for 28 years, give me some secrets to day trading." And I'm like, "Look, there are people that are successful at it, but they are the minority." They're like, "Why don't you do that?" And I'm like, because the probability of doing that successfully over the long term and doing it right, and the discipline and the execution and the research that it takes is really challenging. That's why it's this great pie in the sky kind of lottery mentality theory. There are people that can do it, but they're ridiculously disciplined. They love doing the research that they do, and they're very focused on where they are. That's not the average person. The average person listens to a YouTube's like, "Hey, I can be a gambler. I can be a day trader." They get a little bit of instant gratification, and what happens is they go all in, and then they get wiped out. And they're not the ones that are out there talking about it because they're ashamed in a lot of cases. So we don't hear about all those people that get wiped out from it, but you've got these marketers out there that get people convinced to pull them in. So I think you're probably right. There's some algorithm that either feeds them the right information to begin with, and then the reality of the game sets in.
I agree. Well, for anybody who wants to talk to Paul and his amazing team, please go to peakfinancialinvesting.com. And if they do that, Paul, what will they find there?
As soon as you come through, the team's going to reach out and give you one of two options. You can either start with an introductory call, which is a great call. Just gives you a chance to ask me any questions that you may have. And I always lay the foundation. It's either me, Alex, John, or Dylan, any of the advisors on the team. You can ask us any question. You're not going to hurt our feelings. You're not going to offend us. And if you think it's a simple question, it's probably the hardest question I get all day, quite frankly. So, or people that want to move quicker can do an intro meeting and a planning meeting. You can move from the intro meeting to the planning meeting. That's where I gather all the data, and I'm going to take you through your retirement plan analysis and stress test. We're the only program in the industry that uses actual history. So we can look back and say, hey, if today was January 1st, 1929, and how you're allocated with a non-risk managed portfolio, what would your outcome have been? And then we're going to look at different inflation scenarios so that we stress test you against inflation. That I'm still amazed. I found the program back in 2004, the level of peace that it gives people, and sometimes the level of shock that it gives them that they're overestimating what they expect their retirement to be. But at least we have those hard conversations so that you've got a resilient, prudent plan. It's amazing the impact that has on people. I get amazing feedback about, especially the ones that push back against me the hardest and say, I don't know if I want to do that, right? I'm like, well, look, I can't give you a recommendation until we both know what your risks to success are. Those are always the raving fans on the other side. And then after that, after we've worked out the details, sometimes that takes a couple of meetings to go through the planning process. Then we move to a recommendation because I have enough information, we do on the team, to give you recommendations of different combinations of strategies. And we have multiple strategies that we combine together. So it's not like we have just one portfolio that's out there and everybody gets the same thing. They're combined together to increase the probability of success for the person that we're meeting with based upon their plan. And then if we move to the recommendation meeting, then, after the recommendation meeting, if they want to work together, then we start that process. And our whole goal is to create raving fans out of those that we serve, right? So it's a great process. Whether somebody works with us or not, I always tell people, it's like, look, I'm not high pressure. And this is, I'm waiting on you to respond back to me. And that doesn't mean that I'm not interested in doing business with you. It's just that, I want you to make this decision and we join in this together because you see value in what we have to offer and help you navigate those days ahead. And then, of course, once we start working together, then it's all the other financial planning process that come in. My main objective this year is to make sure everybody has their estate plans in place, financial power of attorney, healthcare power of attorney, and working with people on that because I've seen some pretty negative things there. But I do believe, hey, I'm a little biased, but we've developed this process. I get good feedback, and I believe it's crucial to helping people, whether we work together or not, understand the reality of their situation and different scenarios that can unfold in an unknown future.
Excellent. Well, Paul, thank you so much for your time today.
It's my honor.